who's either going to talk from my phone or he's going to join as well. We're here in Puerto Rico for an investment conference that just wrapped yesterday. That was incredibly
Yeah,
good.
John. Tell John I said hi. That's my
Yeah,
man right there.
yeah. Good morning, Scott. He's having coffee 3 feet away from me here. But yeah, I mean, listen, we big surprise in this morning's GDP numbers that the street was looking for 2%, as everybody knows. So this is a pretty big miss at 1.1. And look, we've been saying we're looking at how the consumer is feeling with credit card debt at all-time highs. The inflation-adjusted savings rates at multi-decade lows. But at some point in time, that seemingly relentless consumer demand has to slow. I totally agree with Neely talking about how ridiculous the surveys are. That one of the questions is who's actually home answering the phone at that point in time, and whether or not they're going to give any remotely accurate picture of what's going on, even in individual households. But yeah, we think that we're going to continue to see the impact of how the American consumer has really been affected by inflation, which, of course, as I say, and I've said on this show and others, they tend to defer the impact of it by just, putting things on the credit card and racking up more and more credit card debt and still taking that vacation and taking that trip and taking those flights, which is part of why the airlines have continued to do well, even beyond my expectations. But I think we're going to see continued consumer demand destruction, which is going to have continued negative impact on earnings. Now, of course, that's a bad news, good news thing, as that's going to give the Fed hopefully reason to do 25 bips in 2 weeks and then finish increasing hikes. John actually thinks we're going to see the Fed start to cut this year. It's one of the few areas that he and I disagree. But I'm going to let him address the audience and talk a little bit about that. But things do not look good for the next couple of quarters for any company that relies heavily on continued consumer demand.
Mark, I can tell you that John and I were literally talking about the fact that the Fed needed to pause. John, what, 9, 10 months ago now?
That's
Last
exactly
summer.
right. Yeah,
Last summer.
that's exactly right. And if I know we've got Neely and the doc and a bunch of folks like yourself that understand how to plot a graph, but if we were looking at 3.2 July through September last year as far as GDP, and then you plotted it down to 2.6, and now you put it at 1, which direction are we going, Scott? Is that from the lower left to the upper right, as our friend Dennis Gartman used to say, or is that rather falling off a cliff, going from the upper left to the lower right on the graph? And I think all of the listeners know it's going from upper left to lower right. So there is just no way that we are seeing, just a booming economy. I'm not looking for a deep, horrible recession, but again, doesn't lay off 7,000 people in a booming economy. Costco doesn't warn as they have. None of these retailers, except the total trade down retailers or trade down like Chipotle versus a Chili's or some of the others, people are trading down. That's just the way it is right now. Again, that doesn't mean that we have to go into a deep recession, but it sure as hell does not mean that we've got a booming economy.
And just to be clear, I'm also with Mark that I don't think they're going to do rate cuts. I don't think they are. Uh, Let me use some good words here. Bright enough to do the right thing here. I think they're going to continue to either hike or pause. I'm actually very convinced that they're going to break everything because now they have a good federal banking backstop, and this banking backstop is now going to embolden them to go even further. This inflation fight seems unreal, and I think they're going to overshoot quite a lot. So I actually will. I can't believe I'm saying this, but I'm going to disagree with John that this is not going to be a very deep recession. I think it's going to be an incredibly manufactured deep recession. What are your thoughts on that? The fact that the big thing that people worry about with these types of Fed moves are the fact that and just to say that, by the way, the market disagrees with me. The 2 year can tell you that the market completely disagrees with me. But John and Mark, what about that scenario that the Fed overshoots like crazy and we go into a pretty deep recession? Patrick will tell you, and we have a chart expert. Patrick will tell you that it's not looking great from the way the charts are looking right now. But would love to get John and Mark to weigh in.
I'll hand the phone back to Mark in a sec. But what I would say is that the likelihood that we're going to see a slowdown is nearly 100%, a slowdown worse than we've seen right here. Heck, they didn't even let us say that last year's recession was a recession, even though it met every criteria for a recession. And yet we came through it okay. Now, if you're right, if the Fed significantly overshoots, which many of us in this room right now probably think that they've already overshot, the question is how far do they push this going forward? And if you and Mark and a number of other people are right, that they keep, their foot on the brake really, really hard rather than just tapping it, then I think we are going to see a deeper recession. I'm hoping that does not play out that way, because that's the last thing we really need right here is, if you think some of the anger and frustration that various parts of the population have right now about economic policy, if you want that to get worse, let's drop it into a deeper recession, and then cities like Chicago will burn, because there's so many people frustrated, so many kids running around out of control, that the deeper the recession goes, the less people have, and the more they'll want to, demonize people that do. And I think that's a real risk. So hopefully, Jerome Powell and the Fed do not push us to the brink by doing that. But I think betting against Jerome Powell doing something stupid is a fool's bet.
But John, you've made the case that they might cut this year.
Yeah.
But tell us why do you think that's the case?
Well, again, Mark and I, and again, sorry about the voice. We were too many cigars on top of the monastery last night over in Old San Juan, Brock's little boutique hotel. But I think what we're looking at is Jens Norvig. When Mark and I were at a hedge fund conference, and it was a very small one. It was only like 20 of the biggest hedge funds in the U.S. were having a dinner at a restaurant in Miami, and Jens Norvig was saying, you look at the bonds and the $23 trillion bond market right here. He said the bonds are telling you that we're going to see cuts if you look, out 2 quarters into the future. We're going to be seeing cuts. I just saw a huge buy of TLT calls yesterday, Doc, and obviously a call buy in the bonds is basically saying bonds up, rates down. Now that was out all the way into September.
What kind of size?
And
What kind of size is
December.
that, John?
What's that, sir?
What kind of sizing are we talking about on there? Because TLT is not very liquid, the options market at least. So I'm curious what kind of sizing you saw.
22,000 contracts.
Interesting.
22,000 calls at the, I want to say 120 strike with it at 103 or something, but I don't have my numbers in front of me right now. Sorry about that, Scott. But that it was a big trade. I think we will see more of those, but if we started seeing more downside bets on bonds, again, bonds down, rates up, then we should start seeing more puts trade in all of the major indices, in particular the triple Q, because the Qs or NASDAQ are so sensitive to a rising rate environment versus most of the other either Dow or S&P or IWM.
But on the other hand, John, we talked about it on Bulls, Bears, and Blockchain yesterday. We have hedge funds short interest in the 10-year, according to CFTC data, at like a record high, right? So that would seem to be an opposite bet.
So the question there, to Mark's point, would be if we're seeing massive shorts in the actual bonds, could we be seeing some of those shorts hedged with the trade that I described? Because you could. I mean, people routinely, if you're a short, for instance, in any stock, you will see frequently the smart money get in there and say, I'm really committed to this trade, but I don't want to get cleared out if it doesn't work. So what they do is they buy upside calls so that they're protected against melt up
Right.
if they're short. And that could be the same thing we're seeing here. It doesn't mean that their commitment isn't just as strong, but it's that they have a fiduciary responsibility and sort of a self-preservation instinct that they want to protect that upside so they don't lose that bet completely. They can lose little, but they don't want to lose big.
Yeah, and in fairness, that huge short trade in the 10-year I'm referring to was a short duration trade, and that long position that John was talking about was a long duration trade. So it could be a hedge on the short, or it just could be the same bet just expressed differently in terms of how long the timeline is. And in this kind of environment, it could go either way.
Isn't it a different way to express this trade also related to dollar, like dollar yen and dollar euro, for example? So, for example, I posted up in the net Stanley Druckenmiller doing his shorting USD trade.
Sure.
But I mean, of course, you need lots of leverage. You know, you probably need an ISDA and other things. But I'm curious about your perspective on either Stanley Druckenmiller's. You know, and he, by the way, for the audience who don't know, he worked with George Soros to break the Bank of England in 1992. So that's probably why, given that he's making this large currency bet now, is probably, you know, capturing headlines. But beyond Druckenmiller, I mean, a lot of people behind the scenes, hedge fund folks are, especially macro folks, are, you know, trying to express this sort of basically directional trade on interest rate. You know, and I think that's really interesting. So I love your commentary, you know, Mark, John, or anyone else on the speaker panel about that.
Take John. It's continued dissing the dollar, but I'll let you get into the technicals, and I know you know Stanley. So,
if we see those cuts, if we see interest rates going higher, that's not one of the things that I would bet against the dollar in that scenario, though, right? If what you and Mark are talking about, and you could be 100% right, if we see the Fed overreach, and cause us to start heading into that deeper recession, during that deep fall into that recession, we definitely see rate cuts. They'd start throwing the kitchen sink at it, especially going into an election year. But with what we have in front of us right now, if we have rates up, that's dollar stronger. And I know that Lagarde moved rates up more than we did, more than our Fed did in the last meetings. She moved up 50 bips. We did 25. But if for whatever reason, in their infinite wisdom, the Fed started hitting it again harder, which I don't think they need to. Again, Mark talked about the GDP coming in at 1.1 today. That wouldn't imply that they need to hit the rates hard right here. But their interpretation of those numbers could be different than mine. And you guys have already touched on Amazon with earnings tonight and how the consumer is doing over there at that behemoth. I would think that those numbers will be pretty telling this evening. And right now, full disclosure, I'm long upside calls in Amazon.
Really? I'm very surprised by that, especially given the market sentiment on Amazon. But we're going to touch on that in a second. Neely, did you have a comment as well?
I just have one, just a reminder, just to remind people just a little, all consumer spending begins with an economic reality. And nearly the entire state of California at this point doesn't have to pay their taxes until October 15. California represents 12% of the covered employment of the nation. You could probably make the assessment that 12% of those tax refunds have not actually been filed at this point, or at least the people who owe. Because you have incentive to file, right, if you are owed. But if you owe, you haven't had to pay. So we have another shadow stimulative effect underway on consumption by simply allowing people to defer essentially their tax payments in a very large state. So just something else to keep in mind as you're navigating this consumer data.
100%. And Alan, did you have something else to add? And then Deer, and then we'll get back.
Yeah, I just want to bring us back to reality here. Venado, which is one of the largest real estate owners, REITs in New York City, has deferred their dividend payment till year end. I don't know what that means, but that's not a good sign here. And look at their balance sheet.
Right. Make sure that people understand what we're talking about. For commercial real estate.
Commercial real estate. So commercial real estate is still hiding in the shadows here. It's a real world problem. We know that the large banks will not be bailing out these real estate companies, these REITs and these commercial real estate holdings, and we don't know what's on the bank's balance sheets also. So that's a shadow problem.
Yeah, Patrick, did you have something else to add?
Yes, hi guys. Well, just for this recession thing, like I would listen more to what the markets are telling us than waiting for some official statements, backwards looking, backfilled, because I put in the space, silver is a great metal to tell us when we're in the abyss of a recession. And if you see silver prices recovering off a huge drop, that's the markets already priced in the recession fears, whether they officially declare that we're in recession or not, who cares, that there was a dip. And if you see silver starting to break out, we're actually in a recovery phase. Because if you look at that chart, the past 2-3 times, not always, in the 70s was slightly different, silver actually bottoms in the abyss of recessions. So if this chart I did back in July of 2022, silver was plummeting, that was actually the markets telling you, hold on, something's off. It was actually pricing it, and silver's about to break out now. So if silver is going to break out, it's a very good sign that if ever we are in a recession, we're probably out of it. And I would probably, if this was a mild one, the bigger recession that we might have will probably be in 2024, like stretched down the road after silver melts up, I don't know to what target, 40, 50. Once it starts crashing and correcting, maybe back to 30 level, that's probably the bigger recession that we're going to have. So right now, that's just like the warm-up act. And just one more thing there, the Fed fund rates, I did a chart super fast. The cuts have different impacts depending where the SPX is in its macro cycle versus inflation. So if I use Producer Price Index as a proxy for inflation, you'll look that clearly when there's these long-term breakout lines, like let's say from the 1950s all the way to the late 1960s, when SPX broke down its upwards momentum versus inflation, the rate cuts that happened after that actually were the tops in the market, and the market just waterfalled down. And in the 80s, when SPX actually broken out versus PPI, each of those rate cuts were actually fueled the markets higher and higher. So just to remove any preconceived ideas people might have on what to expect when the rate cut happens, now the market has broken down versus PPI a little while back. So the next rate cut could be the death knell for the U.S. equities.
So just want to make sure that we can break this down. I put up Patrick's tweets in the nest up there, and really the point that he was making is that silver is giving us a different narrative than what we are speaking of here. Patrick, I want to make sure I understand it, that you think that with silver having a breakout, that automatically means that there is no recession coming?
Well, it means that if we were in one, the fears of it are probably we're out of it. So they might backfill it, say, okay, yeah, finally we were in a recession in 2022 and we're out of it in 2023. And yes, I think the recession fears we're probably out of it. I think there's a bigger one coming, but it's a little later after silver does its rally up, after the US equities try to rally up. Once they start maybe getting close to their previous all-time highs, if ever nominally they're able to do that, then that's when we'll have a bigger, stronger recession that will be more pronounced. But right now, if silver's recovering and going out of its abyss, we could be already on our way out. It hasn't broken out yet. Oil is still giving us some signals that it's having a hard time. You want also oil to get out of its correction above a critical breakout line that it did. I think it has a breakout line that from 2009 all the way to today that it broke out, and now it's backtesting it. So you want to see the markets, those instruments, oil, you want to see silver, you want to see those things breaking out. But more important than that, if silver breaks out and it's outperforming the SPX, that is not good for US equities. That's telling you it's just a bear market rally for US equities in a secular inflation cycle. So that's very, very dangerous. So if you want to be long growth stocks, but silver is outperforming you on your recovery rally, you're not in a good environment. You should be long commodities. Exactly. Once US equities outperform silver on recovery, then fine, commodities, they're probably peaking, you move out of there, then you go growth. So you got to really watch. If you cannot outperform silver, why the hell are you in your instrument anyways, right? It doesn't make sense.
Exactly. No, this is Patrick. Thank you so much for that breakdown. It's so interesting to hear people talk about fundamentals, economic environments, and then the charts. And I feel like Patrick is like believes charts are Bible, and then some of us believe that the economics is Bible. So it's so fascinating to hear the different opinions, and it's very helpful for Patrick to provide sort of some signals that can help us make better decisions. David, would love to get your thoughts, and we'll go back to Mark and John. Would love to get their final thoughts on this. Go ahead, David.
Yeah, I was just to piggyback on that silver discussion. I'm looking at silver relative to gold and relative to the S&P, and it has been on a pretty decent rally here the last like 6 weeks, 8 weeks or so. But it actually, relative to those other instruments, it actually looks like it's peaking, and starting to roll over from what would actually be a lower high point than what it had, relative again to the S&P at the end of last year. And then relative to gold, at the end of last year as well. So I actually think that silver is showing some weakness here as a relative instrument, and is not necessarily breaking out per se. It might be breaking out on an absolute basis, but you have other instruments that are starting to outperform that. But especially silver versus gold, and you look at like lumber versus gold, copper versus gold, which is just on a big drop right now, a big breakdown over the last few days. So I don't think necessarily that those are screaming economic expansion expectations. I think it's actually the other way around. And going back to what John and what they were saying about the rate cuts, I think the rate cut, I think we only see rate cuts this year by the end of the year. And I know that the 2-year is showing rate cuts. I know the Fed future is showing rate cuts, but I also know that the Fed has not been following, that tail wagging from the dog over the past over the past year or so. They've been the one that has the bond market's been having to catch up to the Fed a few times because the Fed's not responding with the rate cuts that the 2 years been pricing in for quite a while. So I actually don't think we're going to get rate cuts by the end of the year unless we're in one condition, and that is that we are breaking down, like the S&P is breaking down below the 200-week moving average, that we are in recession. That's the only, there's way too much money still in the system. When we started this discussion, when I came on with you, an hour and a half ago, you guys were discussing funding, right? How much funding there was out there and what valuations, especially in the AI space. And it was like, there is still a lot of money in the system out there. And for the Fed to cut rates because inflation's coming down, and maybe some jobless claims are ticking up, but unemployment is not going crazy yet, and there's still
you said this at the
a lot
exact
of money
wrong
in the
time,
system.
David. Breaking news: Gap to lay off 1,800 workers as part of broad push to cut costs. I did not time this, David. Yeah. The market timed it. But
Yeah,
yes, layoffs are coming. John is right. I am telling you. So just for people that don't know, my company works closely with employers to reduce their healthcare costs. I am sitting at these tables before the layoffs occur. I am telling you, layoffs are coming across every industry, across every business. They are planning for it. This year at the Society of HR Managers meeting, they are going to have an entire part of the conference focused on how to do layoffs right. I am not kidding. This is coming.
Yeah.
They are preparing for it.
Then rate cuts will be coming too. That's the only
I just think that they'll come too late, David. That's my point. I think that we're working off of 3-month lagging data, and I think that they are absolutely. This is insane that we're even in this position.
Well, we just pumped too much money into the system in 2020. We just had our first 1% month-over-month decline in the M2 this last month. That was the first one. We had a 6%, a 5%, a 3% increase in that month-over-month in 2020. We had plenty, there was so much money that if they cut rates, if they start cutting rates with all that money in the system, then inflation will just turn right back up again. And that's that. I think I think they are going to err on being way
Shipping
too
back then
late.
are close to zero, man. Are we really still having this conversation that inflation
Yeah.
hasn't broken yet? Do you really believe that that inflation hasn't broken yet? Is
Well,
there a
I think
chance?
it will break. I think it will break because I think the Fed will err on waiting way too long to cut rates.
Okay, we agree there. I think
Yeah.
there's building a consensus now. I remember a few months ago people were talking about soft landings and shit, and here we are. But Dear, would love to get
Yeah.
your thoughts, and I want to go back to John and Mark and get their thoughts as well. Dear, go ahead. Especially with these these new layoffs that were just announced like 3 minutes ago. Go ahead, Dear.
Yeah, sorry, I wanted to take it back to John's point because on rate cuts. I mean, I thought that they were going to cut rates in the beginning of the year. I obviously that has been thus far wrong, but I think Powell. His biggest fear is becoming, Arthur Burns. But I think he's going to create conditions in which he's going to end up going down in the history books as being much worse than Arthur Burns. I mean, we are seeing, problems already within the financial system. Obviously, part of that is duration risk. But I mean, if we look at kind of what has happened globally, you have Credit Suisse, which is gone. You have SVB, you have FRC. We had, if anybody read the ECB's financial report, they said that they actually had to pull, it was almost 2 billion euros of provisioning to cover losses that they were taking on US dollar denominated debt just to break even. And so, I mean, I think that if we're starting to look at what's happening globally, things are absolutely atrocious. And, I was even to the Buffett thing. I mean, if you were a Japanese investor looking to try to find yield in the United States, you just can't. Like, if you're looking at 3 months hedging costs for JPY, a yen relative to the US dollar, it is absolutely massive. And then if you factor in the differential that you get from any sort of debt instruments, whether investment grade or high yield, the differential between US and Japanese, sure, the US seems absolutely attractive, but then when you start to pricing your hedging costs there, there's no positive carry for you. So I think that if you start to look at a lot of these things, the Fed is putting the global financial system in a bit of a bind, and then that factors into the offshore dollar funding markets. It kind of funds into all of these things that are going to end up putting tremendous stress on the financial system. And if you look at the cost of just borrowing in U.S. dollars, as talked about with denoted by dollar funding costs, it's absolutely massive. I think it's like 163 basis